shooting.
Hi, I'm Robert Maltbie with Maltbie's Minute on the Market. It's February 9th. Bulls have taken charge. Our MMI indicators have roared into bullish range. This has been driven by three things. Strong technical indicators backed up by strong liquidity indicators, and of course, powered by earnings per share growth and momentum. But first, here's some of the negatives. Our sentiment indicators, the ratio of bulls to bears, measured by the AAII index, is slightly negative at 35 to 32 bulls to bears. Not bad, but slightly negative. Also, as very well noted by most, valuations are at historic highs when measured by PE ratios. Now, they're not nosebleed highs like 2099 at 25 times, more like 17, which is a 10% premium. So we're not bleeding up there. We're not losing oxygen, but it is a little bit high right now. Now, here's the good news, which we think is more powerful. Our technical indicators did break bullish. Every equity index that we cover is now in positive ground domestically for the U.S. market. That would, the laggards there were the Russell equal weighted and the NYSE composite. They've both come through and blown above their 200-day moving average. Now, the other indicators here that look very favorable, of course, are the liquidity indicators, which is money in to the market, positive again, led by M&A and share buybacks. And we can see why, because from the textbook of the investment banker, the whole market really is an LBO. And here's why. You have an earnings yield on the S&P of about 6%. Your cost of debt on quality paper on the S&P 500 is about 4. And you have your tax write-off. So you've got a net spread of about 300 basis points before you talk about accretion, before you talk about financial engineering. So the math works, and that's the main reason why this market is going higher, led by corporate actions. Corporates still have a lot of cash, record margins, profit margins still. Valuations, we think, are positive on net for that reason. The attractiveness of the stock market, evidenced by the earnings yield versus what's available elsewhere in fixed income and cash. Well documented, but it's true. Our target on the S&P 500, in fact, is 2780, up over 30% from here in the next 12 to 18 months. We harken back to the last time oil plunged 50-60%, which was in 1986 to 87, and in fact, the S&P did gain a hefty amount, about 50%. Moving on to our earnings indicator, bullish again. We've got an attractive PEG ratio on the overall market historically, with the S&P trades at a ratio that's about 25% discount to its historical price earnings to expected growth rate, and that's where we are today. So the price earnings to the expected growth rate is attractive. Also, energy and earnings estimates on energy stocks have really plummeted with the oil price, pulling down the aggregate. But if you take out the energy index sector, you find that the earnings growth is actually not bad. For this quarter, Q1, we're looking at an aggregate of 3% instead of flat. And for the year, the estimates are for 8.5% growth, ex-energy. Finally, monetary policy is in fact bullish still. We look at something, one of our indicators called our liquidity index, which measures the Fed compared to the speed limit being GDP growth. The Fed is adding 319 bips positive of a stimulation to the economy over current GDP. Very stimulative there. Also, the yield curve. We hang our hat on the yield curve. It's still a very nice positive slope. with about 0.25% on 1-year paper and almost 2% now on 10-year paper, showing a positive yield spread. Add it all up, yes indeed, despite the paranoia of a crashing oil price, this is going to add about $150 billion into the pocketbooks of the consumer, and this will be stimulative, net-net. We favor domestic issues, consumer cyclicals, restaurants, retailers, specialty retailers, and leisure types of issues. Thank you very much. I'm Robert Maltbie with Maltbie's Minute on the Market.